Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. With bond yields rising substantially over the last month, I'm going to discuss why we've been somewhat more relaxed about this development and what could change our mind. It's Friday, January 17th at 2 p.m. in London. We've thought credit would have a good first half of this year as growth held up, inflation came down, and the Federal Reserve, the European Central Bank, and the Bank of England all cut rates. That mix looked appealing, even if corporate activity increased and the range of longer-term economic outcomes widened with the new U.S. administration. We forecast spreads across regions to stay near cycle tights through the first half of this year, before modest softening in the second half. Since publishing that outlook in November of last year, some of it still feels very much intact. Growth, especially in the U.S., has been good. Core inflation in the U.S. and in Europe has continued to moderate. And the Federal Reserve and the European Central Bank did lower interest rates back in December. But the move in government bond yields in the U.S. and Europe has been a surprise. They've risen sharply, meaning higher borrowing costs for governments, mortgages, and companies. How much does our story change if yields are going to be higher for longer, and if the Fed is going to reduce interest rates less? One way to address this debate, which we're mindful is currently dominating financial market headlines, is what world do these new bond yields describe? Focusing on the U.S., we see the following pattern. There's been strong U.S. data, with Morgan Stanley tracking the U.S. economy to have grown at about 2.5% in the fourth quarter of last year. Rates are rising, and they're rising faster than expected inflation, a development that usually suggests more optimism on growth. We're seeing a larger rise in long-term interest rates relative to shorter-term interest rates, which often suggests more confidence that the economy will stay stronger for longer. And we've seen expectations of fewer cuts from the Federal Reserve, but, and importantly, still expectations that they're more likely to cut rather than hike rates over the next 12 months. Putting all of that together, we think it's a pattern consistent with a bond market that thinks that the U.S. economy is strong and will remain somewhat stronger for longer, with that strength justifying less Fed help. That interpretation could be wrong, of course, but if it's right, it seems, in our view, fine for credit. What about the affordability of borrowing for companies at higher yields? Again, we're somewhat more sanguine. While yields have risen a lot recently, they're still similar to their 24-month average, which has given corporate bond issuers a lot of time to adjust. And U.S. and European companies are also carrying historically high amounts of cash on their balance sheet, improving their resilience. Finally, we think that higher yields could actually improve the supply-demand balance in corporate bond markets, as the roughly 5.5% yield today on U.S. investment-grade credit attracts buyers, while simultaneously making bond issuers a little bit more hesitant to borrow any more than they have to. We now prefer the longer-term part of the investment-grade market, which we think could benefit most from these dynamics. If interest rates are going to stay higher for longer, it isn't a great story for everyone. We think some of the lowest rated parts of the credit market, for example, CCC rated issuers, are more vulnerable. And my colleagues in the U.S. continue to hold a cautious view on that segment from the year ahead outlook. But overall, for corporate credit, we think that higher yields are manageable, and some relief this week on the back of better U.S. inflation data is a further support. Thanks for listening. If you enjoyed the show, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.